Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, Dollar Tree. I've had a lot of demand for Dollar Tree and Dollar General. We're going to go through Dollar Tree. We're going to figure out how much cash money do they make every year as they grow their locations and as sales naturally grow inside the enterprise. How much cash money do they make? What have they been making over the last decade or so, and how much can we make by owning the stock today on a long-term hold? Ready? Let's get to work. Now, like we do with all of our stocks at this channel, we're going to look at 5 key attributes as the foundation for the kind of entry point upon which we would then consider an investment. The first one we want to look for is top-line revenue growth. Absolutely need to have top-line revenue growth. Number 2, earnings growth. We look at EBITDA, enterprise level earnings. Number 3, we want strong free cash flow. Number 4, we want low debt that's less than 3 times debt to EBITDA ratio. And number five, you want a stock that's well priced. Well priced meaning the IRR, the return on the investment, we estimate to be above the market to give us some cushion because we want to outperform the market. That's my objective. This is my vlog, so these are my opinions. Here we go. Let's dive right into the 10K behind me. So this is the annual report for Dollar Tree. I want to bring up a couple things. Number 1, very second page, you can see net sales are growing every single year, and more importantly, the store count continues to grow. So the way we want to look at this business is its number of units of stores nationwide are growing, and then each unit itself is having same-store sales growth. That's what we want to see. So here, growth in sales, yes, and then right down below that on the, right underneath it, it says driving an enterprise same-store sales an increase of 6%. So they're growing their sales at each location, and then they're adding locations, building the portfolio. Those two should compound on each other, both each store growing naturally and then growing locations should produce rapid growth for the business and hopefully earnings growth. Let's check it out. Okay, let's take a look at the financials for Dollar Tree. Behind me is 9 years of financial information. All these numbers are in dollars and millions USD. Their fiscal year ends January 31st, so it's January 31st and back 12 months. So here we go, $7.4 billion of top-line revenue growth in 2013. That number has continued to grow every year. 8, it comes down a little bit. 9, 20, and 21. 21 is January 31st, 2021 and back. $25.5 billion of top-line revenue. That's a doubling it's more than a doubling in 9 years, which is incredible growth. If I were to put that on a CAGR, that's 17% annual CAGR, annual growth rate. And again, that's a combination of natural same-store sales growth, so each store becoming more popular, and then adding locations onto that. They seem to have lots more locations that they can add. And so I would consume this to continue to grow. I don't know if it's that pace, but it was definitely continue to grow. When I look at EBITDA is our measure for earnings, right? We want to look at the enterprise level, the entire business. What does the entire business earn? EBITDA is a guess at kind of cash flow from the income statement. And you can see $1 billion to 2.8, 2.9 billion, depending on rounding that. Which is more than doubling, much like revenue. So, margins have kind of maintained. They've been able to grow earnings. Every year it's profitable. Every year on kind of a long-term average, it is growing. Some years it comes down, but for the most part, it's moving upward, which is what we want to see. And I think that checks both boxes here. You've got strong top-line revenue growth. You've got EBITDA growth of 13% on average over time. That's amazing. So both these kind of low double-digit growth rates checks the box. Let's take a look at enterprise value and see what we got. So first, we're going to pull, long-term and short-term debt. It has grown, but for a company that's got roughly $3 billion a year in earnings to have $3 billion of debt, not to mention net debt, that's not a whole lot of debt. And if they're able to grow like that and not amass a large amount of debt, that means that the business is cash flowing because they can fund a lot of the growth with cash and they don't have to borrow. I really like to see that. So short-term and long-term debt, excess cash, that's cash that's not necessarily needed, which is a lot here. And then market cap, shares outstanding times price. When I add those all up and subtract the cash, I get a market cap, an enterprise value of $25 billion, which has grown substantially over the 9 years, right? Again, so that's more than doubling. It's almost 3x growth in the enterprise value on 2x of EBITDA and revenue, which probably reflects a market multiple expansion and just an overall richer market that we're in right now. And you can see that it's grown 8 to 9 week growth, but it seems like it's peaked around 12 here. But shockingly, for such growth and potentially good cash flow, we'll take a look at cash flow in a second. I'm surprised to see a high single-digit market multiple for this business. I would assume it had a taller multiple. It's interesting that it does not. It's probably just not that sexy being retail, brick and mortar retail. But it definitely produces income and grows. I like to see that. When you look at debt, debt's almost zero with the amount of cash they have on the balance sheet. They can pay off their debt if they need to. So I think this is going to be an interesting candidate to see what the return looks like here with some modest growth. But before we forecast, let's take a look at the cash flow of the business. Okay, like everything, we want to start cash flow from operations. Cash flow from operations is here. This is the top third of the cash flow statement. We look in their annual report. 2013, $678 million has grown to $2.7 billion over that time frame. That's roughly a 4x, which is a strong move, bigger than EBITDA growth. So there might be some change in working capital that's boosting it, but overall, it seems like it's moving in the same direction that EBITDA is moving. That's a 19% annual growth rate, kind of a CAGR across that time frame. Super, super strong cash flow. CapEx, yeah, they've got to put some money back in to grow new locations and expand. So you're not gonna be able to keep all of this every single year. You have to put some of it back. But it looks, when I look at the gap here between what they're investing in the business for growth and the cash that's generating, they're generating an awful lot of cash for a business that's brick and mortar retail, and I like that a lot. If I net these two, that's what, $1.7 billion, $1.8 billion of free cash after investing back in CapEx. CapEx is capital expenditure, so it's building property, plant, equipment, new builds, new locations, infrastructure, IT systems, paint, windows, all that stuff is in here. It's not acquisitions, but it's everything else they need to grow. So that's really surprising, and I like to see that. Debt payments, they have been buying down their debt recently, so a lot of the money that they're generating, they're just using to pay off debt, which I think reflects the low debt position that we see them having. Fantastic. It also means that these free cash flow numbers would be a lot higher if they did not make this payment here, because they don't really have to. The debt ratio that they have here, it's roughly zero because they have so much cash on hand, but this $3.2 million of debt that they have, every year they make $2.8 million of EBITDA. Now there's some things here that aren't exactly passing through to cash, but they can easily afford the debt payments. They don't necessarily need to pay it down. They're choosing to pay it down because they have a lot of free cash flow. They don't know what to do with it. They're just buying down debt. At some point, that debt's going to hit zero, and they're going to have to do something with the cash. That's going to be dividend, buy back shares, make acquisitions. That's what that's going to be. So there's a potential here to get more cash out of this investment in the future. So free cash flow per share, there's a long-winded approach to say I think there's going to have more cash here. Shares outstanding seem to have increased a little bit, but by and large over this time frame, it's been relatively flat. It looks like recently it started to come down. Maybe they're starting to buy back shares, but they're going to need to do something with that cash. When I look at free cash flow on a per share basis, $5.4 per share. I think that number would be even higher if they did not have to pay out here this debt. If I were to zero that out just quickly, this goes to $7.80 a share if they don't make the debt payment. Don't because they don't have to, not because they don't want to again. All right, let's take a look at a forecast, shall we? Let's figure out what we think this business is worth in the future. It does seem to check all the boxes for us. We're going to look at a forecast to see if the forecast yields above average return. Then we can determine it's well priced. After that, we need to go through a lot more due diligence on your end. This is just a math test. But if you like what I'm doing here, you like the process I'm following, please check out my website, cashflowinvestingpro.com. At that site, you will find an investing course where I go through how to digest a 10K. I give you this Excel sheet template. I show you how to populate the historical numbers, where to go get the information, and how to build a forecast. How to do everything we're going to do in this video. If you want to learn to do it yourself, it's not rocket science. And I'm shocked that a lot of the analysts at Goldman Sachs and Morgan Stanley and so forth don't give a more robust explanation for their forecast that they generate. But you're going to see that they use something very, very similar to this. So check it out, cashflowinvestingpro.com. All right, so now we want to forecast the business. So what we're going to do is we're going to pick up from last year's EBITDA, 2021, January 2021, and we're going to forecast it forward. And what I've done is I'm going to use 8% growth long term, which I think is a conservative number. Now, if you recall, they had been growing at 13% annually. They had same-store sales growth of 6% last year. So to go from 6% to 8%, I don't think is a huge stretch. It's also less than what they've been historically growing over the last 9 years, which it might slow because they're bigger, so it would naturally mean that they could not achieve the same level of growth. So I'll bring it down a little bit, but I think 8% is very reasonable for this company. If I do that, then the $3 billion turns into $6 billion of annual EBITDA over that time frame. I give them a 10.7% enterprise value market multiple, which is just the average that they have been experiencing historically. All right, so if I go back, it's just the average of this range. They're currently trading at about a 9x, or at least they were at the end of the fiscal year in January. We're now in November, so it's a bit higher than that now. But the point is, I think that they're not going to get too much market multiple expansion here. It's really just earnings growth that's driving this forecast. Then I keep coming down here. I got a little bit of debt, a little cash left over. Gives me a $63 billion market cap. Divide by the current shares outstanding, and I get a price forecast of $273 per share out 10 years, 2031. Okay, now let's forecast the cash flow per share. So again, picking up prior year's cash flow, this is after making the debt payment, $5.87. That's last year's number growing at 8%. Maintain the same 8% as I did EBITDA because well, basically, any growth that they get on the cash flow statement, the income statement is pretty clean. So any revenue growth that they get, any EBITDA growth should pass through to the cash flow statement. They don't have much debt, so it's going to fall to the equity holders. So that's going to grow to $11.74 per share. 6.2% is the average yield that they've experienced over this time frame here, right? They got a little bit of a abnormal yield here. We can even take this out if we wish to see what does that look like without this anomaly. You got a negative one in here. That shouldn't be there either. That's a 2.8. That's far too low for a company like this. I'm going to leave it at 6. Perhaps these uber low ones and this super high one kind of cancel each other out. So I'll leave it at 6.2. 6.2 gives me $189 per share as a long-term forecast. Okay, so now what we can do is now that we have an opinion of what we believe the stock is truly worth to us as cash flow investors, now we look into the stock market and figure out how much we can buy for the stock for. So I can buy as much stock as I want at $110 a share. Anybody's willing to sell it to me. The question is, do I believe it's a good value for me in my investment? So I've got two different investing valuation approaches. Cash flow investing tells me $189 a share. I get an EBITDA market multiple approach at $273 a share. I'll average these two, call it $230 because don't know which one's right. Well, it's a forecast, probably none of them are right, so it's a guesstimate for sure. But $231 is the long-term estimated value of the shares. We're going to pump this into an IRR where I buy a pro rata share of the business. I get a pro rata share of the free cash flow generated from this business, and then I sell the business out in 10 years. And what that yields to me is a 15% IRR, which is above average yield for an above average return for a stock, public listed stock. The S&P 500 in any 10-year given period of time would have do about 10%. This is 50% greater than that for a company that is grinding out growth, has very little debt, and has been able to is very reasonably priced at a 10x EBITDA market multiple. To me, seems like a strong value play, and there's plenty of protection there. That's basically 3 times your money in 10 years by owning this conservative stock. If I were to put it into a matrix, again, here's our $110 price we buy today, based on these assumptions, which are just totally assumptions. You can make your own numbers up, but I made my numbers up. I got 15%, which to me seems like a very good risk-adjusted return for my money over the decade. If the stock gets more expensive, I won't buy it. If it gets cheaper, I love it even more. But if you look at the 8% growth and you think, hey, look, that's realistically achievable for a business that can both grow same-store sales and grow the number of locations, 8% growth isn't too unreasonable, especially given the double digit they've been experienced the last almost decade. So if they can achieve the 8%, I'm not relying on a market multiple expansion, so I should be able to generate this cash flow and get this kind of return. If you change your assumptions, the return will change obviously, but for this base case, it seems pretty interesting to me. Now what I did also is I wanted to say, well, what happens if growth goes up back more towards a normal level, or let's say I don't need to make this debt payment. Let's say they don't make the debt payment go forward. They don't buy down the debt. They continue making their regular scheduled payment, but they allow the debt to maintain itself, and they distribute that free cash flow. Well, that's going to take our cash flow valuation up a whole lot more, to $160, $260 a share. And if I were to change the growth forecast to 10%, let's just say, still less than the 13 they've experienced historically, but a little higher, that flows through the cash flow statement. So I leave debt alone, and I'm growing a little bit higher. What does that do to our IRR and our price forecast? So that means my long-term price target is actually $320. And if I can buy it at 110 now, I get a 22% IRR, or 4 times my money. Now, that's a bigger assumption, right? I've got both not stopping payment debt, all cash goes out, so no more debt payment, which is fine. They have no debt virtually on their balance sheet now, so I think that's still reasonable. It's the growth assumption. Going from 8 to 10% is a big hurdle, although it's still less than what they've been doing historically. So I think in this range here, you've got a 15% IRR stock that could go to 22% if you stretch your assumptions a little bit. But for me, given where we are in the economy, given the chase for growth that's out there, to have something that is core and kind of basic in my portfolio that has a solid chance to beat the market, and with a little bit of stretching on your assumptions, you can almost double the IRR of the market. That seems really healthy to me in terms of what I'm looking for in a risk-return trade-off. So I'm definitely going to give this one a good. I like this company. I like the way it's positioned. And so let me hear what you think. In terms of our 5 key attributes, let's recap. Top-line revenue growth, yes, check the box at a simple double-digit return. Growth. EBITDA, absolutely, it's growing. Strong free cash flow, yes, it's there. Low debt, absolutely. And well-priced, yes, it is. Because it's returning 15% on a conservative assumption, above 20% on a more aggressive assumption, I think this is a very interesting play for something that would provide some protection to your portfolio, especially if your portfolio consists of a lot of the higher multiple priced companies that historically have reverted to mean. And I think we need to be cautious about a kind of a market pullback or a market move when the Fed stops tapering here next year. So if you like this type of work, please go to my website, cashflowinvestingpro.com. You can find 2 things there. One, the course, which I referenced earlier, that it gives you this Excel sheet, teaches you how to understand IRRs, how to make forecasts, and something that you can do based on your specialization. We all have an area that we focus in. Maybe you work in semiconductors, maybe you work in manufacturing, maybe you work in a shoe store and you see shoes from Airbirds coming through and they're selling like hotcakes and you want to value that company. How do you do that? Buy my course, read their 10Ks, populate this model, and it'll give you an IRR. If you believe in the forecast, buy the stock. Simple as that. The other thing it's going to show you on the website is I have a club, a cash flow investing club. Now I review a whole lot more stocks on a weekly, on a monthly basis than I can produce a YouTube channel. So I take this analysis and I put it up as a one-pager for you to see, condensing all this information into a simple one page that gives you all the information you need to evaluate a stock from an analytical perspective. You obviously still need to read the reports, interview management, do all the qualitative information that you need, but in terms of a forecast of numbers, it's a basis for you to think about it. Check out my cash flow investing club at the website cashflowinvestingpro.com. Okay, thank you. This has been Dollar Tree, a review of the stock. Very, very interesting cash machine. Definitely check out the stock. Feel free to hit the subscribe button and throw me a comment down below. I love hearing the recommendations. I hear you guys. I got to take a look at AT&T. That's one that's on the list to take a look at. But honestly, I want to wait for the merger to settle out before I look at AT&T, so I know exactly what it is we're buying. So that one's going to be on the back burner for a little bit. But I got lots more stocks coming. There's tons of stuff to do. Thank you very much for all the time, effort, and the communication. Really appreciate it. All right, have a good day. Bye-bye.